you don't know what you don't know. And, we all either learn things and have life experience and, but sometimes we try to do things or do it ourselves, but, and we maybe don't really have the expertise or understanding.
Welcome to the Get Invested podcast, where we share great conversations with experts from all walks of life to uncover their secret know-how and where they invest their time, their skills and their money, and the benefits that this has created. You see, the truth is that everyone invests. Every minute and every day we're investing our time, our skills, our energy and our money in something. Some of us are investing consciously, some unconsciously, sometimes for good, sometimes for bad, and sometimes for no impact. Get Invested will help you to start living by design, not by default. I'm going to help you to make it happen, not let it happen. You'll hear the top tips on how you can live with conscious intent so that you can live more, work less, and leave a living legacy by investing now. Listen to the show to discover the top tips on how to get started, make the most of your investment journey, and ultimately to be living your dream, not someone else's. More episodes can be found on iTunes or at bushymartin.com.au/get invested. Thanks for listening, and now let's get invested.
Hi Freedom Fighters. Are you still searching for that perfect and elusive holy grail investment strategy that's high reward, low risk, safe and affordable, and that'll allow you to live more, work less and secure your family's future? You know, that ideal investment solution that will safely and affordably allow you to secure a multi-million dollar portfolio that'll replace your income and sustain your family's lifestyle long term. But in the meantime, it won't limit your lifestyle by eating into your salary or savings, but it will put an extra $8,000 to 20 odd grand a year in your pocket, and it'll help you to pay off your home loan years earlier, as well as save tens of thousands of dollars in loan interest. An investment solution that will enable you to spend your valuable time focusing on building your career and income while spending your limited spare time with your friends and family as your trusted independent professional team looks after your interests so that your wealth grows by remote control. Now, I know what you're already thinking. This doesn't even sound possible. Well, here's the good news. Yes, it is. And Sonia and I are actually living proof of its effectiveness. You see, it's the approach that I've detailed chapter and verse in my recently published book, The Freedom Formula, which you can get on Amazon or download onto your Kindle. And surprisingly, it's not rocket science. It's just a subtle art that relies on combining all of the right proven principles, processes and people in the right way at the right time. Get it right and it's great. Shortcut it, leave something out, or do it in the wrong way or wrong order, and it can quickly become a disaster. It's a bit like baking a great cake. You need a good team of professional chefs using a great recipe, top quality ingredients, combined in the right quantities at the right time, cooked at the right heat for the right time. Get any of this wrong and a great tasting delicacy can quickly turn into an awful mess. Now, in my reading and research over the last 20 odd years, I continue to find that any endeavour continues to demonstrate that only about 5% or 1 in 20 achieve real sustainable success. And today's guest is going to open your eyes and ears to how you can successfully optimise this opportunity and be in the 5%. Richard Crabb is the MD of the Aspire Network, where he's been able to combine his 20 plus years of personal and professional experience across the property, finance and business leadership arenas to create a leading-edge professional and national platform that'll help you to find, secure and deliver the best property solution to achieve your needs, your strategy and your sleep at night factor. Richard's as passionate as I am about the need for independent and impartial professionalism to protect and secure your interests in the property market. And his commitment to improving and regulating the professional standards of the industry has been rewarded with his recent inclusion on the highly respected Board of PIPA, which is the Property Investment Professionals of Australia. Now, during our highly engaging and wide-ranging discussion today, you'll not only hear about this best possible investment approach, but you'll also hear about the future of the property market, and you'll find out what impact the Federal Labor Party's sweeping intended changes to negative gearing and capital gains tax treatment is going to have on the economy at large, but also each and every one of you, either as a homeowner, a renter, or an investor. You'll learn about PIPA in terms of what they do and how they can help you. And you'll also find out how to find a professional independent team that you can trust in all of the key aspects of property to protect your interests and to minimise any risk. If you enjoy what Richard has to say today and you'd like to find out more about the Aspire Network, please get in touch with me either by shooting us an email at bushy@khgroup.com.au or give me a buzz on our landline at 08 83 83 6990. That's 83 83 6990. But for now, get out your notebook and be ready to scribble furiously as you listen and you re-listen to Richard Crabb. Welcome back, Freedom Fighters. It's Bushy Martin. And for those of you who know me pretty well, you'll know that I'm fiercely passionate about the need for independent professionalism in property and finance, and that it covers all aspects of strategy, finance, and most importantly, property delivery. And today's guest, Richard Crabb, shares my vision in this regard for the industry, and he's recently been appointed as a board member on PIPA, which is the Property Investment Professionals of Australia, of which I'm a member and also a supporter. And he's also the managing director of the Aspire Network, which is an independent property research and investment property delivery arm that acts in the interests of investors, not real estate agents or builders and developers. So welcome aboard, Richard.
Great. Thanks, Bushy. I appreciate the time to come on board today.
Yeah, and I've been pretty keen to talk to you for a while, given, you know, your active interest and involvement in PIPA and the awesome work that you're doing with the Aspire Network. But for those who don't know you, mate, can you just elaborate a bit more on who you are, what you're doing and where you're heading at the moment?
Look, thanks, Bushy. So the Aspire Network I founded a bit over 7 years ago, coming out of the financial services industry in very much a niche market. I used to work for Medfin in medical finance, so working with doctors and professionals, which was very much based around the philosophy of look after people, build long-term relationships. Came out of that, and a couple of colleagues of mine have been in the property investment space and sort of approached me and said there's nothing in this space that has any sort of standards or ethics that we see. And when we really looked at it, because it's an unregulated space. And what we wanted to try to do is actually create a framework with structure actually based on the principles of financial planning.
Yep.
As if the industry was regulated, well, how would that look? Very similar to sort of 20 odd years ago when the finance industry, banking and finance, went through regulation and changed. And we wanted to apply the same principle to the property investment space.
Yeah, awesome. Now, just sort of just jumping in there for those listeners who are getting their head around the financial planning exercise, because there are a number of people who have a varying level of comfort with financial planners, and what Richard's really talking about there is the due process that financial planners take people through. And while the property industry has been pretty cowboy in that regard, financial planners, in terms of their needs analysis of developing strategy and really identifying what's right for a client, is a very good process. And it's rarely been seen in the property industry, and it's certainly something that I and my team adopt, and the reason why I feel so comfortable with what you're doing with Aspire. So, sorry, mate, go on. I just wanted to clarify that point.
Yeah, no, and that hits it on the head, Bushy, as well. I mean, the reason why we based it on the principles of financial planning is that property investment is an unregulated space.
Yeah.
One of the things that actually took us the first 3 years after I'd founded the company, working with underwriters. A professional services, so a dentist, a doctor, a financial planner, a solicitor, they are professionally insured with professional indemnity insurance because they're all regulated spaces. What we'd spent that time and effort was improving to the insurance underwriters that even though this was unregulated, we've created a framework that they were comfortable, that now means that all of our property investment advisors actually hold PI insurance, don't have conflicts of interest, and actually work under a code of conduct and framework in the investor's interest, not someone who's just selling something to a client. They're actually working with the client, not for themselves. Yeah,
brilliant. Awesome. So that's very clear and quite a niche position in the industry, given what you're just talking about, because for most people who haven't had the opportunity to enjoy that independent professionalism, they're often at the mercy of a builder, a developer, a real estate agent whose vested interest is in selling the property, and quite often is painting a picture that's serving them rather than the benefits of the investor themselves. So that's I can see that the Aspire network is going to go from strength to strength in that regard, and also the reason why myself and our team know how I've been enjoying building a relationship with you, mate. Tell us a little, before I sort of jump back into your personal and professional journey from earlier on, tell us a bit more about PIPA and your role there, and where you see PIPA and the professional investment, the property investment professionals of Australia assisting potential investors in looking after their needs.
Look, the reason why we joined PIPA, and now why I've also actively joined the board, PIPA have been trying to drive for regulation in this space. And they're actually very strict, even though it's a member-based, not-for-profit organisation. And member-based, they are very selective with, the members that they approve, that they have to act under a code of conduct. So very aligned to what we built our business on. PIPA has done the same thing in the property investment professional space, trying to weed out and actually have people that agree to adhere to a code of conduct, have the ethics and standards, and ultimately as an industry body, PIPA are pushing to try to get some level of regulation, into this space. And that's why, we've joined on board and just, because the more we can bring into this space to get rid of, unfortunately, some unscrupulous players that are out there, that we see all the time. It's going to be better for the end customer, because investing in property can be a very rewarding experience, but unfortunately a lot of people get bad experiences when they're misled by people that aren't doing the right thing. And I think that's where PIPA's from their side, trying to push it. They're lobbying government. Their members do adhere to that code of conduct as part of the membership, and so that helps people, I guess, have a starting point to identify the people that they should be dealing with and the people who they shouldn't.
Absolutely, and I guess from my perspective on that, Richard, I've always said that successful property investment is an elite team sport, and you need independent, objective and transparent players who will all cohesively work together to achieve the client's needs, but they are all independent businesses and therefore don't have a conflict of interest in dealing with the process end to end. So what I'd like to just reinforce for the listeners today is that if you are looking to surround yourself with an independent team in each and every aspect of the property delivery exercise, from the initial strategy piece through to the financing, through to the property delivery end, whether it be by buyers agents, project managers, or businesses like yourself, in Aspire, who operate under that code of conduct, that's a very good place to start the journey. So, awesome. So, and I think PIPA, given some of the machinations that are about to potentially happen politically around property moving forward, if there's a change of government federally next year, PIPA has a very important part to play in educating, communicating, and getting players at all levels to understand what's really going to make the industry work. So, awesome work. Now, mate, I just want to pivot here for a minute, if we can, and go back to the beginning of your journey, because what I'd like to do is, for my benefit and the benefit of the listeners, get some understanding of what your decision and motivations were in both your professional career from early on, but also share with us in parallel with that your investment journey. What have you invested in? What have you learned from it? What's been good? What's been bad? What's been ugly? and then work through to how that's then allowed you to enjoy the success you're having with Aspire.
Yeah, thanks, and happy to share. And I think I'll start with if I knew now what I knew then. If I knew then what I know now, I think my things would be different as always. You learn along the way.
Yeah, exactly.
Yeah, I shake my head with some of my early investment decisions and kick myself for others because I think, as they say, one of my favourite quotes is, you don't know what you don't know, and we all either learn things and have life experience, and but sometimes we try to do things or do it ourselves, but and we maybe don't really have the expertise or understanding. So me, I started back in financial services, sort of out of high school.
Yeah,
worked through a career.
Just jumping in there, why?
Where you want me to start?
Yeah, I'm interested in the why. So, what made you decide to go down that road?
Again, it's really interesting. In school and growing up, I was a computer geek by hobby.
Okay.
And my vision and goal going through high school was I wanted to be a computer programmer. I'd started computer programming, and a friend of mine who was doing the course said how his brother had just got a job at this finance company, which at the time was Avco Financial Services.
Right.
And he said, look, they're hiring. And he goes, maybe you should have a chat. And I actually never forget it because the reason why is I went in, my first interview went for 3.5 hours.
Wow.
And the guy who interviewed me just gave me a pass. But one of the things with Avco at the time, especially their pathway, the way that they basically trained you to run a business.
Brilliant.
You'd start at the front counter. They had such a structured training program to then move to branch manager to run and they trained you to run a branch. But back in those days, a bit unlike today, where it's all very decentralised, they gave you a career and a journey. And he painted that picture for me over 3 hours, and I got the job the next day. And then didn't look back. I then spent the next 2 years working through their training program, and was the youngest branch manager ever promoted.
Awesome.
But you learned everything about business, and and then I spent the next 7 years working with GE and branch management, and then I actually ran Australasia as the national operations manager, running the whole branch network across Australia and New Zealand.
Yep.
So it sort of gave me that exposure of running. I learned how to run a business.
Yes.
And, run big networks and scale, and both from dealing with one-on-one consumers, at the front end when I was in branch management level, to then going to the national. So that was again a complete career change, but just it was something. I learned. I was passionate, and you learned a skill, and continue to get good success. And then from there, I went to another finance company, which was actually Medfin.
Yep.
Which was medical finance, so very Avco or GE money, because GE bought Avco, was consumer, was right. Mum and dad investors.
Yeah.
Small consumer loans, consumer lending predominantly. So then went into and the evolution of that was moving into a niche market, which is actually a very small demographic. So just doctors, dentists. We only lend money to medical professionals.
Yep.
I guess, and I spent the next 7 years. And I originally ran South Australia.
Yep.
I actually set up the operation there. Got to the stage in South Australia where my South Australian business was more profitable than Victoria.
Right.
And Victoria had 4 times the staff and 5 times the population.
Yeah, let's drill into that. Why? I'll be, again, interested in how you managed to achieve it. What do you think were the key seeds of your success?
Aside from obviously the hard work, but there's probably one word I'll use, and that's relationships. The biggest thing with a niche, and this is, again, predominantly the principles of where I founded Aspire later on, was that time, and Adelaide's a very niche market. It's a very small, as we all joke, everyone knows everyone in Adelaide. It took the first sort of 18 months, but it was just about relationships.
Yeah.
I'd go to I pretty much knew every dentist. I'd go to every dental seminar or a medical seminar, and it was about word of mouth.
Yeah.
People, and it actually got to the stage where I actually didn't take on new clients because I had too many clients. That I built that relationship, and they just, anytime they needed finance, they'd, hey, Rich, I need this.
Yeah.
And great. And the first one was always the hardest, but you treat every client the same, whether it was for a $5, for a $1,000 laptop or a $2 million practice fit out and surgery setup.
Yeah.
You treat every client the same. You give them that personalised service. You actually get to learn about the person.
Yeah.
And actually the most rewarding thing I got from it was and I actually missed it when I moved to Melbourne, is because I had is actually that you'd helped so many people grow their business and became their trusted advisor.
Of course.
And that grew the business, and it grew the business, and then they said that's why the company relocated me then to Melbourne to turn Melbourne around and fix the problems that they've been, because Melbourne had been doing the opposite. They just, I'm not saying they didn't care, but they didn't have the same ethos. So and I guess the team that we built in Adelaide it's that one word, relationships. If you're there for the journey, not to sell something, and you're there to work together with people, it's a sustainable business, and it's that word of mouth, people coming back again and again, because they you build that trust and rapport that you're there to work together with them, to achieve what they want to achieve.
Yeah, it's so spot on, and relationships take time. So, and it does. Yeah, you mentioned the 18 months. That's exactly right. It takes that long for someone to know, like, and trust you. But then it's exponential, because if you've invested in that relationship and you've got a genuine care and like for the people that you're working for, they know it. And then the word of mouth just does the rest of the work for you. So, no, awesome, mate. So you then moved on to Dynamics. So tell us a little bit about that.
Yes, I left Medfin. That was a bit of a segue. I guess I've spent sort of nearly 15 years in financial services in very high level positions.
Yeah.
That built businesses, grown businesses. And I guess I wanted to challenge myself. And I actually did two sort of segues out of that. And I did Dynamics.
Yep.
Which was helping try to grow a business, but it was the same principles, but a completely different industry. Chalk and cheese, dealing from medical professionals to, motorsports, was a completely different switch.
Yep.
But it sort of challenged me and took me out of my comfort zone.
Yeah. Awesome.
For that, and then likewise, then I spent 3 years running a drilling company. So same thing. It was a family-run business. It was actually my uncle.
Okay.
Who had a drilling business for 30 years, very successful. It was getting close to success, end of the, so it was really a come up, build it, grow it, sell it.
Okay. And was that in Adelaide or Melbourne?
For the 3 years. Rockhampton, Queensland.
Yeah, righto. Okay. Yep. Excellent. So
3 years I did fly in, fly out from Melbourne.
Wow.
For that period for 3 years, and look, again, we put all the infrastructure, the systems, the processes, we grew the business, we got big contracts, and it was about growth, and but again, I guess I've always liked to challenge myself, but I guess the one underlying thing that always pays off is if you build relationships, do the right thing, obviously you work hard, but it all pays off, and and then from that, when I'd done my job. It was supposed to be 2 years. We did it for 3, and had the exit strategies and handed it over. And then came back and then founded Aspire. Because I said I wanted to build something myself and build something that we could do nationally, and have a business that could help people in a space where, there's just so many unscrupulous players, and but that's why I wanted to apply all those things that I've learned over all those years in different businesses and running companies and building businesses. I wanted to then add enough confidence and faith in myself to do it myself.
Brilliant, mate. Now, there's some really close parallels there with being successful as a property investor, because all the successful property investors I know aren't scared of a challenge. they take calculated risks.
Yep.
So they do the homework, they do the hard work. They're in there for the long term, not the short run. And if I look at your work history, you've invested considerable time in each and every one of those different businesses that you've progressed in. You have the faith to back yourself and to see it through. So talk to us directly on that then in relation to your personal investment journey today. So what was the very first investment you made, and how did it progress from there, and what have you learnt along your own personal investment journey?
Yeah, well, as I said at the beginning, I wish I knew then what I know now. My investment journey, I guess I was very fortunate in some respects. At a very young age, I was in finance. I was earning, at the time, very good incomes for my age.
Yep.
I bought my first house, which I was living in. At the time, I'd sort of been in it for about 7 years, and then my regret then was learning. I got too head up of, wow, I've made some money. I still remember my first house was a townhouse.
Okay.
I paid $94,000.
Nice.
For a 3-bed town, for a 3-bed 2-bar, 2-car townhouse close to a hospital in a good area. It was in Darlington in South Australia.
Yeah, nice.
Then after 7 years, I moved to the city. I bought a place in Carrington Street. My mistake then is I should have held that property.
Right.
And I at that time, I had it for 7 years. It was now worth about, I sold it for, I think, $260,000.
Great result.
Now, again, and I used the equity then to buy my next property. So initially I did lifestyle.
Yeah.
Whereas now looking back, look, don't get me wrong, I have looked it up on RP data. That property is now worth about $380.
Yeah.
So it hasn't really, and it probably won't go much further, but going back to I only paid $94,000, it would have been a freehold property it's actually earning about $380 a week rent.
Yeah, that's pretty good yield. Yeah, no.
From the last up.
Yeah, good learnings.
So that was my first mistake. And then my same with my second place. It was in the city. Again, didn't get very. I was buying them as lifestyle to live in.
Yeah.
But as an investment, even looking back at them now, they wouldn't have been good investments.
No.
They really haven't grown that much in the last 20 years.
No.
The initial one I should have bought and held I should have.
Yeah.
When I moved to Melbourne, I actually bought an apartment in South Yarra.
Okay.
When I moved in there.
Yeah.
Again to live in.
Yeah.
So I had my initial mistake that I made. I got too caught up in capital gains, thinking, it was my primary place of residence. But, that, hey, if I just sell it now and then take the equity and buy another property, I don't pay any capital gain.
Yes.
Whereas if I just buy, if I'd held them, restructured the debt properly, again, all the things that I would do today.
Yep.
Yes, there would be capital gains, but I'd now have a significantly larger asset base.
Sure.
Sure. I wouldn't sell them.
Yeah, good learnings, mate. Okay, so from there, you're into Melbourne?
And then from there, two things. I was in South Yarra. I bought an apartment. Obviously, South Yarra has been ridiculous. I was getting, even the first 12 months, I was getting great growth. And then I had money to spare, so I bought another property in South. I thought, well, South Yarra's just going crazy.
Yeah.
So I actually, again, I just went and bought a student apartment.
Yeah.
Which, by the way, if anybody wants to buy a student accommodation, I'm happy to sell them one. But again, it was at the time, I didn't make any. I didn't speak to anyone. I didn't get any advice. I didn't do any research.
Yeah.
It seemed like a great deal.
Yeah.
But because I didn't do any of that, if I sold it today, and I've had that property for about 12 years, I bought it for $180,000. The best I could get, if I could sell it, maybe $135,000 at the best.
Right.
So it was a learning experience. There's no exit strategy. I didn't do any research. I didn't think about it. It seemed like a great idea. I didn't look at the numbers. I didn't look at the research. Just bought it because it was cheap. Seemed cheap compared to, and it was South Yarra. Wow, South Yarra is amazing. But
yeah, you make a very good point there, because a lot of us early on in our investing career, and I was exactly the same. You go for lifestyle and you buy properties that you would live in, not that are necessarily going to give you the best investment results, and therefore the heart tends to overrun the head, and because you like it and it's easy, you buy it without thinking about everything else that needs to be put before it. And as you would know as well as I, Richard, property is more about the finance and more about the numbers if you're going to be successful as an investor, and the property is actually almost the last thing that you consider once you've got all the other ducks in a row. So
look, couldn't agree more. And
go on.
Look, yeah, couldn't agree more. And as you said, and you learn to, I guess, to think. My last. I guess the advantage now of working in a business where I think we've done just shy of $500 million of residential property over the last 5-6 years. We get to see so many variations and so many different properties. So my last 3 investments, that I've done, are completely different that I would never have thought of doing previously. But now I look at the numbers, I look at the research, I look at the data, and looking at it for the long term of what's going to give me and my family the best, the best chance for the most growth and lifestyle.
Yeah, awesome. So, what have you done differently then compared to in your most recent acquisitions compared to what you were doing earlier?
Yeah. Look, again, the biggest thing now is I don't buy with emotion.
Yeah.
It's not about whether you can drive past it, see it, look at it. I guess what really now I do differently is delve into the numbers.
Yeah.
Look at the research. Part of what we do with our platform, is we use all the different independent research that we pay for.
Yeah.
So you can. I don't look at marketing brochures; they're a waste of time.
Yeah.
What you look at is actually the real. Delve into the census data. You look at the area statistics. You look at the ratio of owner-occupiers to renters. You look at the type of demographic in the area. Look at the population densities. One of the things we look at now, unless there's 100,000 people within 20 Ks, wouldn't even start to look at it.
Yeah.
It's because then you start looking at exit strategies.
Yeah.
What's the potential for growth? Like my last property I bought a house and land property, which actually just went unconditional last week.
Okay.
And the reason why I bought that was the data.
Yeah.
And an interesting side story on that one. I've just bought, myself and my wife have just bought that house and land.
Yeah.
Off plan. So the land won't title now until probably February, March next year.
Yep.
One of our other, and again, I buy what we have on our platform. It's like a kid in a candy store. So I see all these opportunities that come up. I'm like, I want that one. So this property is like, and to put that in perspective, and I've been using this story that the property that I've just purchased, one of our investors in the network purchased the same property. Now, so it's in the same estate, or the land estate, but they bought in one of the earlier stages.
Yeah.
Now, their lot size that one of our investors did is actually an identical house, identical sized block.
Yep.
The house and land package that I've just paid for. Now, this client's land is now settled. They bought it about 14 months ago, roughly, I think.
Yep.
My purchase price that I've just paid, now I wasn't in a position 12 months ago to buy that one because I'd just done other things.
Yep.
I just paid $100,000 more for the exact same package that a client purchased, a bit over 12 months previously.
Yeah, and that's all land growth, land value growth, I'm guessing.
Well, I said the land values alone, have gone up over 10% in 12 months.
Yeah.
And obviously increase in the build, but overall, and even though I'm paying $100,000 more than this investor paid for the exact same product, there's still room to move. Like the median price in the next suburb over is still $150,000 more. There's a new employment precinct that's just gone in. There's a development overlay on the suburb, which means that there's not going to be the urban sprawl. You know, once the supply is gone, it's gone. It's a lifestyle location.
Right.
It's 65% owner occupiers.
Nice.
So it's very few renters. So it's a desirable location where people actually want to live.
Yeah.
Which is why the land value's gone up so much, is because land's in such high demand by people wanting to buy it to actually live there. The values are just going up as they release each stage in this estate. It continues to grow.
Yeah, and the other good thing about what you've just mentioned...
Sorry,
mate, with those overlays that are eventually, once the development's complete, will constrain ongoing land availability,
correct.
Then suddenly you've got a contained exercise with high demand and no further supply. So the ongoing opportunity to enjoy the capital growth that most investors are looking for is very well positioned. So that's awesome. And there's a number of key things that you've mentioned along that discussion around why that property in that area is good. And if I was to summarise that for the listeners, the difference between what I see successful investors like yourself doing, Richard, and those that don't do quite so well, is that you're putting on your future telescope and you're looking at this area in the context of what's it going to be like in 10 or 15 years, not what does it look like now or what has it performed like over the last couple of years, because quite often I see investors piling into areas where it's just been through a fairly big spike in growth and then it's just going to plateau and sit flat for anywhere between 5 to 8 to 10 years, whereas the smart investors are looking at what's committed, what change is coming that's going to affect demand and supply, and where is the employment and the jobs with strong incomes
correct.
And growing incomes in that location that are going to continue to support higher prices. So you've just sort of covered off very neatly on a lot of the very key parameters that investors need to start thinking about, and that is throw away the rear vision mirror, get rid of the microscope that looks at today and put on that telescope that looks at, okay, well, what's going to change this area, and is that going to be a benefit to property values in that particular location? So that's gold. But,
you summarise that beautifully, and it's that desirability too. Like, you know, we sometimes see a lot of product. You know, this is why when we look at the census data very carefully, my acquisitions manager is the only one that I know that got extremely excited about census. He was like a kid in a candy store. Now we look at all that data very carefully, but we also pull out there's some those really key things, which is what you just said. You know, looking at the ties to professionals, what type of jobs are around, what type of people are living in the area, what's their median income. Yeah. You know, and also the desirability of the product. You know, when you look at one of the good things in census too, if you're building a 4-bed, 2-bath, 2-car house and land, and that suits the demographic. You know, you look at the number of cars per household. Yeah. So if the average cars per household is 2 cars, and you go and build a 1-bed, 1-bath apartment, that might not suit the demographic for that area.
Spot on.
So you can it's also making sure the suitability of the product, because you're going to be renting it out while you're holding that asset. Yeah. You know, and looking at those things around that, you're matching the type of property is actually going to match the type of people that are actually living or wanting to live and rent in those areas.
Yeah, that's a very good point.
And just on the other point on that too, and one thing that we're very passionate about as well as type of people, put your tenant hat on. Yeah. So the people is the rental pool as well as the demographic. Yeah. You know, you don't necessarily want a low socioeconomic demographic. Yeah. But you know, like it's the little things. Like we always make sure you got stone bench tops. Yeah. You know, sometimes, quite often in investment properties, they use laminates, and it looks cheap. Yeah. What type of appliances are going in? Yeah. You know, so some of those little things. When you delve into the suitability of the product for the location, type of tenant, that you want to walk in to go, wow, I want to live here and make this my home.
Yeah.
You know, and
Yep.
We find that makes a big difference too.
Massive difference. You touch on some really good points there, because I've often said there's a massive difference between low cost and best value. And what I mean by that is that quite often the first time investor is looking cheap, because they want to get the cheapest property they can, and if that's your only driver, then you end up buying the wrong style of property in the wrong location for all the wrong reasons. And I'll drill into this a bit with you shortly after we've covered off some other things. But the quite often you can spend more money, but it end up pulling less money out of your pocket if you've structured it the right way. And those little things, some of the little things on the property front that you've picked up very well, because my wife and I owned a rent roll business, a property management business for over a decade. And we used to say to clients who would ring us and say, right, we're going to build a property in this location. We're just going to build a 3-bed, 1-bath, 1 garage. And we'd say, well, we've got to question why you're doing that in this particular location, because families are predominantly the renters, they're professionals. And the difference between, let's take the garage as that example, the difference between a single garage and a double garage is a difference between $10 and $20 a week in rent. And if you're looking at that rental yield helping to subsidise the cost of holding onto the property, if you look at that over the period of time you're going to hold it for 10 or 15 years, that's a massive difference just by spending a couple of extra grand on an extra car space. So it's the jigsaw that is really important. And while property isn't rocket science, it is a jigsaw and it is a cobweb, and you need to have all the strands and all the pieces of that jigsaw together to make sure that those that are successful, and I don't know about you, Richard, but I think the average, if I looked at the true success in property in any other arena, there's about 5% who generally do extremely well and the others do mediocre. If you join all the dots on all these things that you're covering off on, then you're reducing the risk and increasing the chance you're going to have a much better result over the long term. So that's really good, mate. Now, what I'd be keen to now jump into, using that telescope that I'm talking about, if we sort of focus a bit on what is your perfect lifestyle, and what I mean by that is, what does your life look like? Perfect day, perfect week, perfect month, perfect year. And is there a difference between that and what you're doing now? And if so, what are you proactively investing in on top of your business and your current investment properties that's going to help provide the income that's going to sustain that ideal lifestyle for you long term?
Yeah, look, for myself personally, I guess if I look at my ideal week, preferably not being on a plane. Sometimes I have to travel a lot, and I forget what state I'm in.
Yeah.
But look, really, to me, it's a balance. It is a balance. Life's about working on your passive income. I guess continually. For me, it's about balancing between work and family. And I guess all the things I invest in and try to do is trying to create a life. Trying to create that passive income. Minimise tax. To really maximise, basically the ability to have cash flow and be able to do the things you want to do, whether it's travel, spending time, doing things in the home, family, but you create all that by, working hard and doing things that give you either passive income, and I guess probably the biggest thing I've learned too, and one of my personal goals is to be as, the best way to put it, de-leveraged. There was a time in my life there, high flyer on very large corporate incomes, but I also had just the same amount of income on my credit cards that I was racking up.
Which is not unusual.
Oh, look at you go! I went through that. Sometimes you live outside your means, and I guess what I actually enjoy more now is I don't have a credit card anymore. Yeah. Whereas at one stage in my life, I had a 6-figure sum on credit card. And a bit embarrassed to say it, but yeah, again, I was earning big incomes to support that. But I live and learn, and now not having those debts or that pressure also helps make better decisions, because if you're not too heavily geared, or don't have big debts or big outgoings, get more incoming than going out. It gives you the ability to make more informed decisions and not do knee-jerk things, if things change.
Yeah, that's a really good insight, and there's a lot of professionals who find themselves, and I was no different either years ago as well, Richard, living the high corporate life. I felt like I had to keep up the Joneses. I felt like I had to present this picture that I was a hero, and I was suffering what I now call lifestyle inflation. The more I earned, the more I spent. And it's the old story.
Yep.
It's not what you earn, it's what you spend that actually makes a difference between someone who does well financially and someone who doesn't. But it's probably a wisdom thing, mate, for blokes like you and I who, we're quite career focused, we're pretty ambitious. We want to look and feel like we're making a big difference. So you do put yourself in a position early where you're probably living above and beyond. And then the danger with that, of course, is that you have to work harder and harder to sustain that exercise, and it becomes a treadmill that's very difficult to get off. So it's some pretty valuable lessons that you've learned along that journey. And mate, that's been really interesting. What I'm keen to do now is change gears a little bit, because it's still related to the future, but something that I guess have been doing quite a bit of research on and have some concerns around is that the talk of the Federal Labor Party introducing, almost revolutionising the tax regime, not only in property and other areas, but for small businesses. And as a very active property investor myself, the elimination of negative gearing on existing properties and cutting in half the capital gains tax discounts is, from all the research I've done, and I've been tapping into some very good independent research done by the Riskwise group, who very clearly indicating that everyone's going to be affected by that. And it's not just the investors, homeowners. The general homeowners will be affected, and renters are going to be affected. So there's no one who's likely to escape from the impacts of this. And the sort of projections that Riskwise are doing on some very conservative modelling is they're seeing 9 to 12% drops in property values generally. They're seeing rents rise quite substantially because the supply end will drop off because people just won't invest. And the thing that they can't put a number around is the impact of the perception of property. And what I mean by that is that the value of anything is only based on what people perceive its value. And if Aussies move from our love of property to a point where we lose confidence in property because of those changes and no longer see property as the place to park our money, then there's a very real chance that we're going to see quite significant slips. And the real concern there, obviously, is that given that most Australian families, the majority of their wealth sits in the value of their home, we could very easily slip into a recession that we didn't need to have. What's your views and thoughts around that, mate? Just interested in getting your take on all of that.
Oh, look, it is a real concern, and I was even just having this conversation yesterday with one of the other board members of PIPA. PIPA getting on the front foot to be lobbying and talking with governments, to not do the wrong thing. Because as you said, it's ripple effect. It's a whole big picture that it just affects so many things. It's robbing Peter to pay Paul. If they try to use it for some reason, to say we're going to get more money and then spend more money on X, but so many layers it could affect people, both from the building and construction industries, which employ hundreds of thousands of people, through to the mum and dads who, as you said, have equity tied up. Even from the housing supply, the concern there too is, and you just said it previously, people invest, and while you make an investment decision, is to get a return.
Yeah.
And, the negative gearing and those, those offsets, give the ability for people to buy property and hold, offset their holding costs, and it provides housing for people. If people start pulling out of that market, it deflects employment, it deflects growth, as you said, price values, and then that ripple effect goes down to the renters. If there's less people buying investment property to invest in as a return because the government's now made it not a viable investment, people will park their money elsewhere.
Yeah.
And it will have an effect across. So, look, I know from PIPA's level, we'll be lobbying and talking very heavily with the political parties. Because again, it could do something no different to when they changed the depreciation laws. It's also the way it's communicated.
Yes.
Unfortunately, even like recently, the thing that I get, when it's communicated by the media or the media communicated as doom and gloom, it also sends ripple effects through, the whole market, and consumer confidence. Just like when 60 Minutes did an article not long ago on, the doom and gloom of property values dropping. Which, don't get me wrong, there is areas around Australia that 100% are overpriced, and they will have correction. Yep. There's also lots of areas that is good buying. There's always good and bad anywhere in Australia.
Well, interestingly enough, just reinforcing that very point, and you're right, the 60 Minutes and a number of other media outlets love to feed on either greed or fear, and fear tends to sell newspapers.
Yes.
And but if you look at the cold hard facts, out of the 12 major areas around the country, only 3 of them have seen negative growth over the last 12 months, and that happens to be Sydney and parts of Melbourne. So, the other interesting fact around that also, Richard, is that while Sydney has seen quite meteoric growth over, the previous 4 years, if you look at the last 15 years, Sydney was actually the worst performing area for property in terms of capital growth around the country. And what we've seen there is it's a catch up and then an oversell, and all we're seeing now is just the normal market correction that happens cyclically every 8 to 15 years. So unfortunately, the media and the pollies and now the banks who are taking advantage of the villainisation of investors, creating this 2-tier lending environment and making investors pay a lot more for the same thing. And I think the overall concern there, as you've very well pointed out, is it's the way the message is communicated, and it comes back to providing all the information, not just the bits that scare people, that can portray it. And you're right, my joint fear with you is that the fear-mongering around the negative gearing and capital gains treatment can amplify the issue to the point where people are making ill-informed decisions that's going to have unintended consequences on everyone in terms of whether they're renters or property owners. Thanks for sharing your thoughts on that, because it's a sleeping giant issue, I believe, that isn't really getting highlighted to the level that because people aren't appreciating how much of an impact it's going to have on living conditions, wealth, and living costs across the board. So some interesting challenges in that regard. But in talking about that, and I guess it's fair to say, Richard, that one of the lessons that I think you and I have learnt along the journey, because I like you, early days my properties were more lifestyle driven from a decision, and they were all existing properties. But the holy grail for any investor that everyone's trying to achieve the magic code is a situation where they can build a potentially multi-million-dollar property portfolio that puts money in their pocket every week. It doesn't impact on lifestyle. It doesn't bite into salary or savings. It can keep anywhere between 8 to 12 grand a year of income in their pocket, and it can enable them to pay off their home loan years earlier and save tens to hundreds of thousands of dollars in
in interest as a consequence of that. You and I both know what the secret to that is. Would you like to share your learnings around that and the way you're now approaching the property side to achieve those things?
Yeah, look, definitely. And if I could just quickly go on with it, but there's just one little point. I just want to go back over what you just said about the fear-mongering with the media.
Sure.
Just to close off on that.
Sure.
If you don't mind.
Yeah, absolutely.
One thing that gave me a bit of a laugh, 60 Minutes did this doom and gloom about how, the end of the world was coming for property. But, when you step back and actually look at it from an objective perspective, television stations are there to sell adverts.
Yeah.
Ultimately.
Yeah.
And I don't know if you might have noticed, but the adverts that they ran during that 60-minute segment was Channel 9's The Block. Which is one. So it's complete. Even that TV station is trying to present a 60 minutes documentary thing, and then in the ad breaks they're advertising one of the most highly overcapitalized properties that you can think of.
And high risk strategy.
A high risk strategy, well overpriced, buying an emotion. And it's just I guess when you really look at it, the media portrays these things, but really they're just trying to sell papers.
Well,
that's just
actually, I'm glad you went back to that because I was actually part of that 60-minute story, Richard. And what really appalled me and disappointed me, mate, was that when they interviewed me for that story, they said, we've heard people talking about potentially 40% drops in property values. What's your commentary on that? And I said, it's never going to happen. We're seeing a normal correction in the market that's going to be anywhere between 9 and maybe 15% in very isolated areas.
Correct.
And that's normal and expected. We're just going through if we go back through the cycles of property over the last 100 years, this is a normal part of the cycle. So I have no concerns about it whatsoever.
Yeah.
Yes, in every exercise where people have bought at the peak of the market and they've leveraged to the max and they're living above and beyond their means, then they are going to get caught. So there's going to be an isolated number of people that will be caught by that, and that's more about their ignorance than their intelligence in terms of getting caught up in the emotion of feeling like they're going to miss out and they have to get in. But reinforcing your point, the disappointment for me is that all of the positive information that I communicated during the interview with the 60 Minutes team was cut out of the story. And the only bits that they grabbed onto were the bits that were reinforcing the gloom and doom exercise. But here's the good thing, and you've touched on it as well, and I've made these comments to others. 60 Minutes' role is to highlight a situation, and by going to the extreme, that program was now 6 or 8 weeks ago. We're still talking about it. And the fact that we're still talking about it, I think, is positive because it gives people like you and I an opportunity to share what the real facts and figures are so that people are getting the information that they need to be making much more informed decisions on what the truth is. So, thanks for coming back to that, mate. But returning to the... Let's sorry, mate,
and that really actually follows... So thanks for letting go back, but that also leads into like what you just asked now, which is that buying property can be a rewarding experience, but it is about making sure, this is where the right advice and the right structures, the key things that we make sure, and, that, as you said, property can be very easily positively geared. From a cash flow perspective, there's lots of different strategies, with the right advice and the right people that you can implement what they call an ITWV, so income tax withholding variation. So if you are a PAYG, you have got the ability to have the benefit of maximising your tax. And getting those deductions to offset, the investment, so that the taxman does help. In a classic example there, we had a lady, she was a professional, she was earning $230,000 a year, on her income.
Yep.
We sat down with her, and we actually did a what if I had, and we said, look, great, and she's very busy professional, high income. Obviously, at that level, she's paying 50 cents in the dollar tax, nearly.
Yeah.
In the top tax bracket. We actually said, well, here's your tax return. Had you bought an investment property on the 1st of July for that financial year, we worked out on all very conservative numbers. One, it would have been, she was actually going to be about $5,000 a year positive in her pocket.
Yeah.
As a minimum.
Yeah.
And then even at very conservative capital growth, I think we both, she basically lost about $20,000, and this has been highly conservative.
Yeah.
By not having an investment property.
Yeah.
And it was purely because she's paying, it's in a very high tax bracket.
Yeah.
But regardless of your tax bracket as well, the advantage is there are tools out there that you can, as you said before, structure your finances right, gear it correctly, maximise the tools that are out there, such as, and that income tax withholding allows you, it's basically the equivalent of getting your tax refund in advance.
Yes.
So, as you said, from a weekly cash flow perspective, there are strategies where, submit to the government, if you would have got maybe a $10,000 refund because of all the property deductions at the end of the year, you can actually apply to have that with your employer, not taxed during the year. So it just means it's giving you weekly cash flow or fortnightly cash flow rather than waiting for a lump sum when you submit your tax return.
Yeah.
So little strategies like that, and as you said, don't overgear.
Well, and there's a couple of key things there that are sitting underneath this as well, and that it's the penny drop that you've obviously recognised, and I did. Sometime into my journey, and that is the benefits of building over buying. And it's become, the gap between those two is actually widening from an affordability context, because with the minor tweaking of negative gearing last year, when plant and fixtures and equipment were removed from depreciation unless you put it in new, the massive benefit of building is that, one, you're only paying stamp duty on the land, not the full value of the property. So, depending on where you are, that can be a saving in anywhere between 10 to 20 plus grand. And then the depreciation benefits on the capital, the plant and the equipment can significantly reduce that taxable income. And as you say, depending on how much income you're earning, we run detailed analysis of this all the time, but it's not difficult for someone on an average combined household income to be keeping somewhere between 8 to 12 grand a year in their pocket on a $450,000 to $500,000 property. And when you put that back into the mix and then apply what you've talked about there with the PAYG tax withholding variation, so that, let's say the 10 grand that you were going to get back as a lump at the end of the year, you're getting it back that every week when you're paid. So there's, just shy of $200 a week going back into your cash flow. That's the difference between the average first-time investor who, over 50% of first-time investors sell a property within the first 5 years. And I know damn well that for all those that I've seen in the time I've been in the industry, that's because they haven't structured it the right way to make it cash flow affordable. And when they start having issues with employment, or they're sending their kids to private school, because it's actually been biting, $200 or $300 a week into their pocket, it becomes unsustainable, and then they knee-jerk and get rid of the property early. Whereas if they'd seen through the advantages of buying a real home for real people in a growth suburb, and then structured it the right way in relation to the financing structure, but also the taxation structure by having a good accountant on the team, then you turn quite a costly exercise into something that's cash flow neutral at worst. And therefore they can get on with their career focusing on growing their income while their property portfolio financially is looking after itself without impacting or hamstringing their lifestyle in the process. So for me, that's been the holy grail without doubt, and it took me a while to work that out. It's something that, and the reason why
you hit on the head there too, Bushy, with it is about the numbers. and doing that detailed analysis is
Yeah, that's spot on, and it's the reason why the working with yourself and the Aspire network has given me that confidence, because you're getting good quality properties, they're good quality new builds, you're putting the energy into the specifications and the areas where you're spending the money that's not only going to attract a better tenant and then ultimately a better buyer at the end of the journey, but you're also tweaking that so that you're getting maximum depreciation out of those fixtures and fittings on the new build property, that's then reducing the cost of holding it. But the other almost counterintuitive exercise that a lot of investors don't see is that if we've structured a property in such a way, and let's say we're putting 10 grand a year or a bit more back into their pocket because the tax man's taking less, and that same $200 a week is going into an offset against your home loan, then you're going to pay that home loan off years earlier and save tens of thousands and perhaps even over hundreds of thousands of dollars of interest, depending on the size of your mortgage. So it's this old philosophy of, well, I'm just going to pay off the home loan and then live off my super. I don't want to invest in property, it's too risky. That strategy is actually higher risk than investing in a good quality new build rental property that's going to help you get the title back to your home years earlier than what you otherwise would. What's your thoughts around that?
Buying new is, I guess, all I've done now, and as a network, that's all we do, is brand new property. There's so many more benefits we've found with buying new. I guess a couple of things there is the ability with brand new, you get the most amount of tax deduction, which can also then help you maximise, as you said, your deductions and enable you to actually pay off personal debt sooner. Because you should always be trying to pay off non-tax deductible debt while you've got tax. We've as I said, all my properties now, I only ever buy brand new. Some of the other key things is the cost savings too. Duty, as you said, you save significant amounts there, along with also the lower maintenance and making sure it's a more desirable product. There are different strategies. You can buy existing and renovate and pay more money. Where buying brand new or building, a house and land, you're building a brand new house. So a lot more desirable, a lot more deductions up front, can certainly help, offsetting those tax bills we get from the ATO, and a more desirable product that people want to live in for your tenants. Because, like buying a brand new car, when a house has got a brand new house smell, it's a lot more desirable than living in a house that's 30 years old.
Yeah, that's a very good analogy, and I guess something I'd like you to expand on as well, Richard, is that often people can hear and see the benefits of new building, but they're too scared to go through the process because either they've never done it before. It can take an extended period of time. If you're buying an existing one, it's done and dusted in 3 months. If you're going to go and find a block of land and then get a builder, and is the builder going to look after me? And there's a lot of fear around that, the risks perceived with that building process. What do you say to them when you get that sort of feedback?
Well, look, that's again something we've been passionate about. It is a complex process, but when you do it every day, it's easy, and that's what we do. And it comes back to whether it's one of our network or having the right team. There is people out there that know and understand the process, and there's very good builders out there. Yeah. Unfortunately, there are a lot of bad builders too. Yeah. But with the right team, and keeping that monitoring and tracking, one of the things we do very carefully, we track it is a process. We've built a very structured system around tracking that process, having the ability for investors to be actively involved by having logins to a platform where they can track what's happening, what's going on, getting progress photos. There's a lot of, builders have got license and obligations. There's things you can do throughout the process to make sure there's quality control. It can be a very simple and easy process. Yeah. But again, I think stems back to what you mentioned very early in our chat today is have the right people around you. Yeah. Get that guidance, and property investing can be rewarding. Look, as well as obviously I love being an active investor myself. And look, I know the process because we deal with it every day with people right across Australia. But I actually get more enjoyment from when we see first time investors or see people who are trying to build a portfolio actually implement, because we've been able to work together with them and coordinate that team with all the right professionals doing all the right things to make something seamless, again, a rewarding and enjoyable experience, so that they're excited to go on and build or buy the next investment in their portfolio, because it has been a good experience.
Yeah, and I guess talking firsthand, Richard, on my personal experience with your team through the Aspire network, because I've been a big advocate and personal fan of building investment properties for a long time, and up until coming across you and your team, I've personally burnt a lot of hours and a lot of time travelling the country, talking to builders on the ground, property managers, all the necessary people that you need to make this happen. But as a one man operator, effectively, and certainly we've got good results from that.
Yes.
But what has attracted me to what you're doing is not only do you have an awesome communication platform that documents everything, every communication is there as a track record, so that the client, ourselves, and everyone else is on the same page. But what you bring to the table is the quality of property research that you bring, in terms of identifying, where's the highest growth location based on this particular price point. And then once you drill into that location, because you've got such a strong leverage position to be able to bring on board only those builders who meet the standards in terms of quality, time and cost, and therefore have the ability to negotiate much more strongly than an individual investor or I would be able to, and then to keep them honest, because if they don't do the right thing, they're off your panel and won't ever be able to offer opportunities again, gives you quite a unique position in that regard, in making sure that not only are you looking after the investor's interests, but you're able to secure better properties at a better value with a better result than what either they could or others would try to do.
Yep. Look, and thank you. And look, you hit it on the head. Look, one of our key things with our business, things go wrong. Things you can't just say it's always going to be a good experience, but things happen.
Yeah.
And what we've learned over the years, there's a couple of key things. So one, with our builders and vendors, we've been able to build some great relationships. But one of our key underlying principles is we have a one-strike policy.
Yeah.
If things go wrong, and they do, but it's not so much about what goes wrong, it's about what they do to work with us and the investor to resolve the problem.
Yeah.
And that's what we're, if for some, and we've had, there's a lot of builders and suppliers that we won't touch or we won't deal with.
Yeah.
Either through we've done our due diligence on them and we just won't start doing, or if we have done a build with them and they don't do the right thing, they get blacklisted from our whole national network. We're not interested, regardless of who they are or what they do.
Yeah.
If they don't look after the client and the client doesn't get a good outcome, we move on. So that's sort of one level. But to get to that level, I guess, as you said, one of the things I was passionate about doing was giving people like yourself, with our network, the ability to have an engine behind them that, as I said, just in our research and acquisitions team, we've got 5 full-time staff.
Yeah.
And one of those travels the country on a plane, visiting the locations, meeting the builders, going and visiting their previous builds, looking at the finished product. When they deliver their first property with us, we go and look at it.
Yeah.
We get independent inspections. We have that quality. We've built relationships, and our vendors know too that we won't accept a good outcome for our clients. And that's, I guess, the power of having a national network, is we've been able to build those relationships, and it gives a bit of weight. too, because for us it's about the client, because we want the client to have a rewarding experience, so they're not, not put off to go and buy their second, their third, their fourth, their fifth property.
Yeah.
And that's, as you said, yes, things go wrong, but we're here for the whole journey, and we've had experiences where things have gone wrong, but then as a network, I can pick up the phone to the builder's director and go, "Are you going to fix this?"
Yeah.
I'm quite often bad cop, unfortunately, if I have to be.
Yeah.
But the fact of the matter is, if someone goes direct and it's just Mr. and Mrs. Smith building a property with a builder who does, 500 build a year, it can sometimes fall on deaf ears. But when obviously as a national network, we'll quite often do more than 1 or 2 builds a year with them.
Yeah.
They're quite keen to normally listen to us when we pick up the phone and call the director of the company.
Yeah, exactly. That volume leverage that you bring to the table in terms of getting issues resolved and ensuring the ongoing quality and responsiveness is you can't put a value on that, Richard. So, mate, that's awesome.
Thankfully, we don't have to do it too often, but when we do, and again, that's why it's a one-strike policy. Do it just, and there is a lot of really good people in this.
Yeah.
There's a lot of bad ones, but there is a lot of really good ones out there. And if we can help match people, and also, but behind that, as well as the builder, the other part which you mentioned too, which we're passionate about, and we pay for a lot of independent research. We built our platform as a communication tool, but to deliver unbiased information.
Yeah.
So when an investor looks at a property, we present it warts all.
Yeah.
It's to actually give them all the facts, independent research, analysis, so that together with their professional, they can digest that, to understand it, to make an informed decision.
Yeah.
There's no crystal balls, but if you look at the data and look at the right data, not gloss. And if there's one takeaway as well from my side, don't look at the glossy brochures.
Yeah.
And there's some great, very pretty brochures and marketing material and sales material, but that's what it is. It's sales material. Delve into the data. That's where the data and the numbers and the structure and everything else, and dealing with the right team, that's always going to help make it a sustainable, long time and enjoyable experience.
Yeah, no, very well said, mate. Awesome, mate. Now, I'm mindful of your time, so I want to switch gears a little bit into what I generally refer to as the ambush, which is the bushfire lightning round that just plays on the old bushy tag, mate. And it's just 5 quick questions that all of the listeners keep wanting the answers to. So, and you might have mentioned this one already, but what's your favourite quote and why?
Yeah, very, very simply, as I said earlier, if I knew then what I knew now, I would have made different decisions. But in saying that, you live and learn. And I think it's just about taking that on right advice and listening to people. Don't always try to do it yourself. Get the right advice from the right people. And that way, young Richard, 20 years ago, if he'd maybe gone and talked to some people rather than thinking he knew it all himself, might have made different decisions.
Yeah, no, well said. Mate, what about reading material? What's the top book that you would recommend people read and why?
Look, for me, there was 2 sort of mindset-changing books that, it was probably 3 books for me that have really, and both either on audio or print, I quite enjoy listening to audiobooks. That if I can give to my top 3 is How to Win Friends and Influence People.
Yeah.
I think that's it's Dale Carnegie going back to the very early years, but the principles just apply to so many things in life.
Yeah.
The second for me was the 4-hour work week by Tim Ferriss.
Yep.
Especially moving into the more entrepreneurial, and that book was quite fundamental in me taking that next step in my career.
Yep.
And early on from a property investing side, which again I wish I'd read earlier, was Rich Dad Poor Dad.
Yeah, it's a classic,
in
isn't
my
it?
very early days.
Yeah.
So they're probably my top. They're probably some of my top 3, but yeah.
Yeah, they're enduring. Each of those have been Bibles to me as well, Richard, at various stages of the journey, and they're just. I reread them, and you know that Dale Carnegie's was written in the early 1900s, but it's still as relevant today as what it was then. So quite enduring in that regard, mate. What about if we switch to a topic that is top of mind to a lot of Australians, because there are a lot of hardworking Aussies who feel they pay too much tax. What's the top thing that you've done to minimise the tax that you pay?
The biggest thing is through property, you know, and making the right using property as a vehicle, but structuring those, you know, to have the biggest tax deductions possible. Yeah. You know, and also working closely with my accountant as well to, you know, keep good records.
Yeah.
You know, to make sure that I can get the fullest deductions possible.
Yeah.
You know, but also have that record keeping and everything. And but property by far, as far as minimising tax, both when I was a PAYG and obviously a business owner, you know, has the biggest deductions overall has been through property investment.
Yeah, no, that's a very good advice, mate. Talking to the personal side of things, then what's a personal habit that you adopt that contributes to your investment success?
Yeah, look, I think it's about taking emotion out of it for me, and originally I was more emotive driven. Yeah. I guess the biggest learning was twofold. Was one, take like the helicopter review approach. Don't just, you know, the devil's, sometimes they say devil's in the detail, but sometimes you need to take a step back and the big picture. Sometimes we can get too focused in the right here and right now.
Yeah.
So learning to take a step back, and also don't be, from an ego perspective, don't be afraid. You know, as I said, and like if going back to another quote, it's my favorite too, is that you don't know what you don't know.
Yeah.
And there's a lot of people out there that will happily share that and have wealth of experience and knowledge that you can tap into from mentors and professionals that will share and help you because they've done it.
Yeah, exactly.
So seeking that, talking to people and surrounding you by people who, you know, are going to be where you want to be.
Yeah, no, that's awesome advice, mate. And that's a nice segue into the final question in the ambush. What's both the worst and the best piece of investment advice that you've ever received to date?
The worst one was, mate, I've got best. If you invest, they're going to go through the roof. I had a mate, friend's cousin's uncle, heard that this company's going to go through the roof because they found oil. So off I went and bought shares in Lakes Oil. And, you know, I was supposed to go from 4 cents a share up to like $1 a share. I think they're still sitting at about 2 cents a share. So that was definitely my worst.
Yeah. What about the best?
Yeah, so, look, the best, and I joke, my joke is it's above my pay grade. My best advice now is when I want to buy a property, as well as I do my own research, my acquisitions manager, who's also a friend of years, when I want to buy a property, because that's what he does every day, you know, I know what I'm doing too, but he knows it better than me, and I'm not too proud to go, right, where's the best one that we've got right now, and what do you think, what are your thoughts? And, you know, my last few properties, you know, have been guided, as well as me doing my own research, but, you know, my starting point was listening to someone who knows something more than what I do.
Yeah, that's absolutely awesome advice. And if we can keep our egos in check and keep humble enough to recognise that we're smart enough to hone into the expertise and experience of people who know better, then life will be a lot easier. And it took me a long time to learn that lesson, by the way, Richard. Mate, that has been...
Me too.
Well, that's been absolutely awesome. Mate, sort of bringing it to a close, what's next new and exciting for Richard Crabb and the Aspire Network?
Look, we're really excited, you know, is as a business, we've obviously continued to grow nationally, you know, and we're helping more and more investors every day. One of the exciting things for us, you know, again, we've got a lot more businesses now. Because we've actually been at the forefront, we're getting more people coming to us now as far as big businesses who are looking at ways of helping their clients, coming to us. So we're really excited. Ultimately, from Aspire, I just want to see getting the message out there of people getting the advice from the right people.
Yeah. And
that's what I'm passionate about, and that's both personally and professionally, that if you help people, it all what goes around comes around.
Yeah, I think that's a great message to finish on. Is recognise that anything, and including property investment, is an elite team sport. Make sure you're surrounding yourself with people who are better than you and know more than you.
Yes.
Make sure that each of those is independent, objective, and transparent in their communication, which is exactly the reason why I'm now talking to you today and working with you to help other investors enjoy that level of professionalism. And mate, it's been a real pleasure having a chat to you. I know the Aspire Network's going to go to bigger and better things, because if someone like myself's on board, and I am pretty fussy who I outsource my reputation to, Richard. And I've certainly...
Well, and likewise, we've been privileged to see what you do too.
Yeah, thanks, mate. Look, keep up the great work. We'll obviously continue to be doing stuff together, but would like to check in with you again in the future on and Get Invested to see what's happening and to talk about sort of common areas of interest that investors want to learn a bit more on.
Look, that's been great, and thank you again for the opportunity, and happy to help and share and discuss anything at any time.
Thanks, mate. Appreciate your time. Cheers, Richard.
Likewise. Thanks, Bushy.
Well, freedom fighters, how good was that? To get a summary of all this investment gold in the show notes, just email me on hello@khgroup.com.au. That's hello@khgroup.com.au. Or check us out at www.bushymartin.com.au/Get Invested. I look forward to joining you next week for another episode of the Get Invested podcast. So thanks for listening, and as always, dream as if you live forever and live as if you'll die